You see how the red line is now above the black line? See that? Red line's now above the black line. That means we've got $25, haven't we? We've got 25 positive dollars. That's going to put a bid into the bond market. So if we've got 20 at a discount, of course, not at a premium, $25 is not enough to buy to buy at the top edge of a bond. That's not going to happen. But because this price is coming back into this previous trade area here, we obviously are aware that this is quite an important price level. So I'm going to be using those DV01s to make some money. If the red stays above the black line, which at the next candle, it was still well above the black line in terms of relative value. The black line hadn't even taken out the prior high at that stage. I'm still thinking that the bond is going to come back up and retest 136s. So I'm using the DV01s to guide my narrative, because this tells me what the bank's DV01 is. Why does this tell me what the bank's DV01 is? So we're using the curve as a DV01 trade, aren't we? A DV01 adjustment. Because the bank holds FOB spreads. The bank holds knob spreads. The bank holds spreads of all different durations. So when there's a DV01 available, and we know what the DV01 is, we know what the next piece of the jigsaw puzzle will likely be. The next jigsaw puzzle piece, red above black at a discount, as was the case here, as was the case in here. Red above black at a discount price. At a discount price, the red started to rise above the black here on a relative value basis there. And again here. That means that the banks hold positive 25 basis points, $25. Huh? So if the bank holds $25 DV01s, the dollar value of a single basis point, then there's more likelihood that the bank will use that discount to buy into. So it's another way of thinking about the DV01 skews. It's another way of thinking about the skews doing the actual math behind it, since it seemed like the market maker math seemed to have a few supporters. Learning and understanding that process from a market maker standpoint seems to give people a little bit more of a kind of hands-on feel about what they're doing with the trading. So that's why we decided this morning to try and approach the bond with a slightly more mathematical slant, thinking about where the bank's DV01 ownership is located, and then saying, right, well, if the bank's DV01 location is a bid, well, let's buy some bonds and let's see if we can get, at least worst case, a stop at break even and try and make some money out of it if we can get a quick scalp into it. Still not taking into account the yen, the gold markets, the equity markets, the shape of the curve, still not taking into account the real yields, still not taking into account inflation break even, still not taking into account any of those other elements at this stage, because we've got to learn this before we start factoring in the other pieces, correct? So you might disagree with the trade because the yen's going up or down. You might disagree with the trade because the real yields are going in a different direction. I don't really care. We're not doing it because of the other lines. We're doing it to learn this line and this line only. And that's what we're trying to understand. This is all. No, we just did the classroom this morning, Reeve. If you weren't in it, it's basically the FOB spread and the knob spread, and that's it. This is just the FOB spread and the knob spread. We're trying to learn it based on that simple little dynamic. So it's a 4x1 and a 3x1, 4x1 and a 3x1.